Let's get in an important market voice to try and understand what is the outlook for 2026 from their lens. Vinay Jaising, CIO and Head of Equity Advisory at ASK Private Wealth, with us on the show. Vinay, great having you. Thanks for taking the time out and lovely talking to you as always. Are you more constructive, Vinay, than what you were, let's say, 3 months ago with how we are ending the year with all the GST cuts, the quarter two, the way it's shaped up, and the fact that India has massively underperformed the rest of the EM pack, therefore resetting the base a little bit?
Very well put, and I think that's the reason why we should be a lot more constructive. Let's just look at two baskets. One is the fundamental reason, and the second is the valuation reason. On the fundamental front, in the last 3 to 6 months, the banking system liquidity has improved. Interest rates have come down. For the year as a whole, interest rates are down by 125 basis points. CRR has been cut by 100 basis points. So all of a sudden, the banking system, which had a liquidity issue, now is in surplus. So you are getting loans. You've seen the loan book growth also come up. Second point, fundamentally, with the GST cut average by about 1%, things have got cheaper, especially for the masses. As a result of which, last 2 months or you've seen some better volume growth on the consumption front, which was a very big key negative point which we had, when we moved through the year. Third, from Jan to October, if you look at analysts, you've seen analysts cutting numbers for next year by 10, 12% at least. This is the first time wherein we are seeing the pivot or, earnings move up for F27 and F28. And people are talking about 15 to 17% growth for the next 2 years. Again, F26 to 28 is a little better because F25 to 26 was a tepid year, single-digit growth. And now all this comes strong fundamentally when you look at the other part of the story, which is valuations. One way of looking at it is year-to-date, emerging market is up almost 20%. China is up almost 30%. MSCI World is up 17%. And in dollar terms, India MSCI is negative. And a small cap has underperformed in rupee terms by about 4-5% for the year, which means in dollar terms, there's another 11% underperformance. So India, be it large, mid or small, has between a 20 to 35% underperformance coming, which means valuations, whatever they were a year earlier, despite the earnings growth of 7-8% for India Inc., have gone cheaper, which makes a much more robust case for us to get into 2026.
Vinay, would the earnings delivery or growth for 2026 be largely driven by consumption and capex led with related to consumption, or could it get divvied up between the two? Because we're not quite seeing strong evidence of either private capex or even government capex with the finances being slightly stretched.
I think the growth would come from the third, the financial sector, because if you look at it this way, the loan book growth has just started moving up, right? You've seen a full year of the loan growth growing from 15, 14, 13, 10, 11, 9, and finally you're seeing the loan book growth move up. When the loan book growth moves up and you've got lower interest rates, consumption should take off, but end result of that is, be it NBFCs or be it bank, they would gain from a higher loan book growth. So I think the loan book growth for FY 26-27 should be at least 150 basis points more than FY 25. Which should have, NIMs being stable to inching up, which means I think the entire banking sector, the NBFCs, whatever their growth was in 25 to 26, should be much better off in 26 to 27. So that's step one. Step two, the consumer plays. Certainly there will be some growth coming in from the consumer players, but here I would add, I put telecom as a consumer play. So that would be the highest growth arena as far as we are concerned for overall growth in the consumption basket, followed by the auto sector. Finally, moving on to the capex part of the story. Yes, capex by the center has been in line or largely better than expected. You've seen 50% year-on-year growth, for the first 7 months. But state and corporate capex has been rather disappointing. And out of, just giving a number of 23, 24 trillion rupees for capex for the year FY26, out of that, half depends on center. So that part of the leg is being ticked. So you've got to be very selective on capex companies who've got a good order book and who are seeing growth coming, and that should drive their earnings as well. One joker in the pack really is the US tariffs with India. If the tariffs come down, the earnings growth would get propelled even faster.
Okay, so that's an interesting point for me to take off from. Vinay, in fact, I was going to ask you partly about that, right? Before I jump into some of the domestic factors that you've already highlighted, that external front and that external environment, from our perspective, is a little wobbly or uncertain. But also, if I look at from the perspective of the US capital markets, the US economy, the US monetary policy, and broad policy direction. So we have had a pretty rough 2025. We've underperformed capital markets globally. Is there a concern in your mind at all, given what you're seeing from overseas, and you throw Japan and central banks into the mix as well, that any global shocks in 2026 could worsen our experience even further? What is the risk of that occurring?
I would turn this question exactly the opposite. I think the year 2025, despite the Indian economy doing significantly better than the rest of the world, has underperformed on the market. That's the starting point. US as an economy in the year 2025 did not do as well as they would have expected. The GDP growth, most of the estimates, it came lower than expectation, which is why the interest rate cuts have come out there. Now, two things hitting the US market is, if you had to look at the interest rates of, you mentioned Japan versus US, Japanese interest rates have gone up by 110 to 120 basis points. As against US, the interest rates have gone down by about 75 to 80 basis points. So there's a 200 basis point increase if you were putting Japanese money in US. And I think that Japan carry trade now is behind you. So for money to go more into the US markets may be a question mark. That's step one. Secondly, though the AI players have been doing really well in the last 12 months in US, as I said, Magnificent Seven is up between 22 to 25%. If you look at the last 15 days to last month, you've started seeing a lot of tinctures, especially in the mid-cap names, largely originating of, because of, the smaller names having their own chipsets come up, leading to a confusion of what's going to happen to NVIDIA's growth. And also you've started seeing a lot of stress come up because they want more debt to be raised for the data centers, which they are raising, which on the longer term is a must. But for a smaller company in AI picking up debt, probably making losses as well, US hasn't seen that. So you've started seeing some risk off trades happen, as a result of which, even if you look at crypto currencies, or if you look at bitcoins, you've seen a 25 to 30% correction in the last 3 months for them. So I think US as a market, there is a lot of liquidity. The earnings growing from the 30% of the market cap, which is AI, will be a robust 20-25%, but there is a consumption slowdown there. India, on the other side, when we didn't participate, with the rest of the world, whatever the correlation was, last year it did not work at all. I think in the next year too, the correlation with the global market, which may correct or, start stabilizing at current levels, you may see a lot of the money come back to India. 2 points for India. If you were to invest in India last year, the currency was 82. If you're investing in India today, the currency is 90, right? So this big differential just of the dollar appreciating is making India a lot more lucrative for US investors. They're today at 15.5% ownership in India, as against a peak of 20%. Right. So they just this 15 days, they've taken out $2 billion. You may see it actually the other way around, that, FIs which have been slipping and taking money out in January start realizing that, when they're looking at asset allocation, India is looking a lot more better. And as you start seeing the pivot in earnings come back in the country, you may start seeing them put in a lot more money. So as against one engine which is driving India today, which is retail SIP, you may start having two engines driving the Indian equity market next year.
Okay. I was asking actually primarily from the perspective of we've not seen a crash on Wall Street in a while. And, of course, you can't predict that necessarily, but I was asking whether there's a vulnerability from that perspective. You've kind of answered that. But what I want to know now, heading back to the domestic factors, Vinay, that you've so aptly highlighted, delving a little deeper into that, if you're saying that earnings look better, and beyond the financial space, what leads that? You've kind of answered that. If you can delve a little deeper into that and say, is this going to be top line led in FY27, or will you have to wait for that to take place in FY28? So
I think the earnings for banks will be top line led because that's the loan book growth. So the financial part is easy with 35-40% of most of the indices being the financial led. You'll see a lot more contribution come for them in the next year or next 2 years into the foray. So that's step one. Step two, consumption companies don't give you a big growth in terms of earnings. So it's 10 to 15%. I won't be as excited there. The next space you're going to be excited on is, companies which are running based on dollar. If the currency is 90 as against the currency being 82, whatever people say they've hedged 50, 60, 70% of the currency, the impact of the export companies in India, be it IT, be it the pharmaceutical names, be it those names in capex once the tariffs, come back to normalized levels, you'll start seeing those companies contribute a lot more to the profitability of India Inc. Finally, so you had financials, you had IT. I think in healthcare with the currency will do a lot more better. Finally, on the capex front, and I'm going back to your colleague's question, you've got to look at some names. Those names which have a lot of domestic orders will do much better because they've already got an order book for this year and next, which will lead to the earnings driving coming in out here.
Got it. Vinay, what about the tech-led businesses? I mean, the market caps of some of these, Meesho's cost 1 lakh crores today. And the debates over whether there is pricing pressure on food delivery for Eternal and Swiggy continues to remain. There's a new player coming. Other corporate houses eyeing that space as well. What do you do with these businesses?
So, see, for us, we firmly believe, one, cash is king. If you can see in the next 2 to 3 years profitability come up for any of these names, right? Since you mentioned the food chain, if you're seeing, them having enough of subscribers and them growing impressively well. Purely, I'm talking about the food chain. You would start seeing them drive profitability because they would already have an EBITDA growth. The problems emanating more so, in the other in the QSR chain or also in the chains where you're doing e-commerce substantially, where competition is coming up. There, whatever your profit experience would have been and your estimates for the next 2 years would go ahead by 1 to 2 years. So we would be a little wary there. So for me, again, not an easy answer to give. Where I can see profitability come in the next 2 years, and that's largely, in those platforms where we already have a big subscriber base. And, the deliveries are increasing by the day, both in terms of size as well as number of subscribers. I would look into those names, but I would not look into the commerce names directly. I would be a lot more concerned because of competition seeping in out there.
Vinay, always a pleasure speaking with you. Thanks so much for taking the time for speaking to us on NDTV Profit, and season greetings to you, your family, and your team.
Cheers. Same to you.
All right, let's talk about the equity markets, and we just about nudged into the green. So we've